Hi, everybody, and welcome to the July 28th, 2017 weekly market wrap for executivebuying.com. We had a pretty busy week this week. Last week I was on vacation, so I wasn't able to do a video. But this week was interesting because we were in a position where we actually took off three winners and one loser. So let's start with the loser, the one that didn't work out so well. That was Build-A-Bear Workshop. In this particular company, we added it sometime around middle May, and we did see a little bit of a pop here at the end of May, but it just really didn't work out. It didn't go very well for us, and it went down about 15, 16%. So that's not a good thing. It's a loser. Um, it broke our $10 uh, weekly stop loss, and we had to get rid of it. So just wanted to take that off the focus list and move on. And that's sometimes just what you have to do. So to continue to move on to the other companies that we took off the focus list, in addition to Build-A-Bear Workshop (BBW), we also took off, excuse me, MBI, which is MBIA. Now this particular company, we actually made a total of 7.41%, and that was a gain um, on this particular company, and we did that just in a couple of months here. So as you can see, we had a nice little uptrend. Nothing to write home about, not a home run, but not a bad gain for a couple of months. And the other company that we took off of the focus list goes by under the ticker symbol LAND. Now, this is something that I actually want to get to towards the end of the video. These little blue lines here in the chart, here and here, that's just indicating that they're paying dividends. So this particular company pays a dividend monthly. So we were able to lock in a 7.15% gain on this company. Once again, we didn't hit a home run with it, but a moderate winner for the amount of time that we had it, and that's not a bad thing. Now, I'm going to get back to this, like I said, later, but the dividends, I think it's just important to note one thing, and we'll go ahead and get into that once I get done with our additions and subtractions from the focus list. So the last company that we removed this particular week was ADC, and another real estate company. We made 8% on this particular company here, and we were able to get out pretty much near the highs so far. And we had a nice little run up from the beginning of July towards the end of July. And once again, even on this one, you actually see a dividend that was paid while we held on to it. We got into this thing right here in the beginning of May. So three winners, 7.5, 7.1, and an 8% winner, and one loser of about 16%. Those were the four companies that we took off of the focus list this week. Um, a lot of these didn't reach their targets. The reason why I took it off was simply we're getting too many companies on the focus list. So that's a good thing that we continue to see insiders buying shares, but I don't want to have 45 companies on the focus list and then all of a sudden the market drops and I have to take off all these stops. So I rather start to, kind of trim the trees a little bit, especially with the winners. I mean, I don't mind taking an 8% winner over a 2 month period. If I could do that every 2 months, I will do it. However, as time goes on, what you want to do is you want to keep the stronger stocks on there, and eventually the stop losses will get take care of themselves as far as the downside goes. So the company that we added to the focus list is a company that I'm sure you guys have all heard of or maybe have used, which is E-Trade Financial. It trades on the NASDAQ under the symbol ETFC as an E-Trade Financial company. Now, we added this company once again near highs. I mean, we're at all-time highs on the Dow, so that's par for the course here. So we're at 4102. We're expecting this thing to get to just under $50, and our projected risk here is going to be about $37.50, which is just about the top of this range right here. So one of the things that I wanted to do with this particular company, and the reason why we added it, was I wanted you to realize that the director of the company, his name is James Healy, he purchased about $200,000 worth of the stock, right at $41.97 a share. So we're actually getting it about a dollar cheaper than where he bought it. But what was interesting about his purchase, and what we're looking at here is a monthly chart, was that back in 2015, he purchased another $250,000 worth of the stock at $26.75 a share. So if you take a look, 2015, right around this level, he bought shares. It went up to this point where it's at now, about a 56.89% gain. And rather than just holding on to it, he's stepping in with almost another $250,000 and buying more stock. So I know I kind of beat a dead horse with this every single week, but if they're not forced to buy shares of the stock after it's gone up by 57% from their initial purchase, why the heck would they buy more shares? And the reality is that they wouldn't unless they think it's going to continue to go higher. Now, they may be wrong, and that's why every once in a while we take off losers, but most of the time they're right. So that's why I want you to kind of get in the mood of, or in the, in kind of the mind frame of not worrying about where the stock has been and whether it's high or low, and just following what these insiders are doing. Now, I believe that price does matter. And in fact, I believe that when you see a stock price that continues to trend higher, the propensity is to continue in that direction. However, I don't want to look at a stock price at 42 and you look in 2012 and it was $7.50 and say, hey, that's too high for me. Well, that's looking in the rearview mirror. How do I know in 2 years from now the stock's not going to be at 142? I have no idea. So you got to keep your mind open with this stuff, or else you're going to cut your winners probably too quickly. So just wanted to put that point across. And just one more thing, and I'll be quick because I know we're kind of running late here with the video. So this is the S&P 500, the Spider ETF monthly chart. There's a lot of political stuff going on, people getting fired, people fighting, people talking nonsense. I get it. It's not always great, but the bottom line is that the market is continuing to trend higher. We continue to have higher prices. There's a continued higher demand than there is supply. Earnings are better. Insiders are buying. So, yeah, I'm bullish. And you know what? I should be bullish because the market is at all-time highs. Because if I was if I was in the mindset that, looking at this chart and in 2014 I said, you know what? This S&P 500 ETF went from $60 to 180. It tripled and it's too high and I just want to get out because I think it's too high. That's a gut feeling reaction. That's something that you try to avoid because if you did that in this particular chart, which mimics the S&P 500 at 175 to 250 essentially, you would have missed out on that whole move because you thought it was too high because you were looking back at where it's been and not where it's going. So keep that in mind. I know it's easier said than done, but definitely keep that in mind. The other thing that I just wanted to squeeze in here was about dividends. So when companies pay dividends, okay, let's say you get, I'm going to be extreme just to prove a point. Let's say you get a $10 stock and it pays a dollar dividend. Um, just for example purposes, it'll pay it once a year. Okay. So this $10 stock that pays a dollar dividend, a lot of people, when I spoke to them in the past, they've told me, well, hey, let's just look at when the dividend comes out, buy the stock before the dividend date, and we'll get that dollar free. Well, that would be awesome if it worked like that, but unfortunately it doesn't. What a dividend is doing is they're actually taking a piece of the stock price and giving it to you. So the $10 stock on X dividend date will actually trade at $9. And the people who owned it at 10 will get a dollar in dividend. And the people who owned it after the ex dividend date won't get the dividend, but they'll get the stock at $9. So I just wanted to make that clear. Dividends are not free money. What they are is they're small pieces of the stock getting turned into cash and sent in your direction. So if you guys see dividends pop up, they're great, nothing wrong with them. But when you look at the overall picture, they should be added into the price of the stock, not necessarily looked at as free money. So I think this might have been the longest video I've ever done. It's 10 minutes, and I'm sure, um, it's probably beyond a lot of people's um, expectations as far as length goes. So I'll wrap it up. I appreciate you guys listening through here. I wish you have a great weekend. Enjoy the summer, and I'll talk to you soon.